balance sheet. Introduction. In this module, you will learn about the balance sheet, which helps to calculate the profitability, liquidity, leverage and efficiency of a business. Topics to be covered. Introduction of balance sheet. The components of a balance sheet. Assets. Liabilities. Net worth or equity. The accounting equation. Understanding the balance sheet. What does the date on the balance sheet mean? Introduction of balance sheet. A balance sheet is a formal document that follows a standard accounting format showing the same categories of assets and liabilities regardless of the size or nature of the business. Accounting is considered the language of business because its concepts are time-tested and standardized. Even if you do not utilize the services of a certified public accountant, you can adopt certain generally accepted accounting principles, GAAP, to develop financial statements. The strength of GAAP is the reliability of company data from one accounting period to another and the ability to compare the financial statements of different companies. The standardization introduced by commonly defined terms is responsible for this reliability. The integrity of any financial statement is directly related to the information that goes into its construction. You may want to consider revamping your record keeping, if necessary, before you begin compiling financial statements. A balance sheet is a snapshot of a company's financial stability at a certain point in time. It's a list of what the company owns, assets, and owes, debts, liabilities. At the end of an accounting cycle, such as month-end, quarter-end, or year-end, balance sheets are typically prepared. A balance sheet should not be completed at the end of a 12-month period or at the end of an operational cycle for a new company. A comparison of balance sheets over time will provide a clear image of a company's financial health. It serves as the foundation for a more sophisticated review of the company when combined with other financial statements. A company's flexibility and liquidity are also assessed using the balance sheet. The components of a business balance sheet. The balance sheet represents one day in the life of a business. It shows how much of a business is owned, assets, and how much it owes, liabilities, on that one day in time. In other words, it is a snapshot of a specific day in the life of a business. The difference between what is owed and what is owed on that day is the business's net worth or equity. A business balance sheet has three components: assets, liabilities, and net worth or equity. The balance sheet is like a scale. Assets and liabilities, business debts, are by themselves normally out of balance until you add the business's net worth. Assets minus liabilities always equals net worth or equity. Assets. An asset is a resource of economic value that a company holds with the expectation that it will help the company in the future. For example, a company will purchase a forklift with the intention that it will aid in the movement of goods that will be sold and that revenue or value will be added to the company as a result of the sale. As a result, the forklift has added financial value to the business. There are two types of assets in a business: current assets and non-current assets. The asset's liquidity defines which group it belongs in. The ease with which an asset can be transformed to cash is known as liquidity. Current assets are assets that can or can be converted to cash over the next 12 months. Of course, the most common current assets include cash on hand and inventory and accounts receivable. An account receivable is short-term financing a business offers to its customers. In most cases, a company will give its consumers 30 to 60 days to pay for a product or service after it has been delivered or performed. They record this as accounts receivable on the balance sheet before the customer pays, and it is converted to cash. Inventory that a business holds is considered a current asset because of the likelihood that the inventory will be sold within the next 12 months, which will then convert to cash. Non-current assets are assets that will not be converted to cash within 12 months and are normally used ongoing to run the business, such as the forklift in our prior example. Most non-current assets are considered fixed assets and include equipment used in running the business, furniture and fixtures, and any real estate the business owns. Liabilities. A business's liabilities are obligations the business owes. As with assets, the liabilities are broken into current liabilities and non-current liabilities, most often called long-term debt. Current liabilities are obligations that are scheduled to be paid over the next 12 months. Most common current liabilities include accounts payable, business line of credit, and the current portion of long-term debt. Accounts payable are short-term obligations owed to suppliers or other creditors and are normally paid within 30 to 60 days from the day of delivery of a product or the performance of a service. Business lines of credit are used by businesses to service some short-term needs and are paid generally from the collection of the business's accounts receivable. The current portion of long-term debt is the amount scheduled to be paid on long-term obligations over the next 12 months. Long-term debt is loans incurred by the business to finance long-term or fixed assets for the business. Net worth or equity. Net worth refers to the value of ownership. The business's assets and debts limit the ownership. The ownership of the assets is only the value of the assets, less any debts with a pledge against those assets. This meaning is encapsulated in the fundamental accounting equation, which defines the owner's equity in the business as equal to assets minus liabilities. Businesses grow through building their net worth or equity. The main goal of every business is to see this growth. There are various ways a business can grow its net worth. The most evident is to decrease debt. This means a business will have more ownership in the business's assets since less of the assets will be pledged to debt. The greatest contributor to the growth in a business's equity or net worth is retained earnings. The earnings of the business become equity in the business in the form of retained earnings, which is listed as such under the equity section of the balance sheet. Another way to grow a business's net worth is through an outside capital injection. This is most often money put into the business by ownership or by outside investors. This normally shows as capital under the equity section of the business's balance sheet.